And we have a determination of a quorum. This time we'll open it up for public comments. Any public comments? No? All right, we'll move on to new business. First one, we have the actual plan expenses as of September 30th, 2025.
Okay, on the tablet, it's just going to be page 2. So the actual expenses, the left side is the budgeted amount for the 2024-2025 fiscal year, and then the right side is what we actually spent. So obviously the issue is that we don't want to be over our budget, so we were under it. The budget was 140, we came in at 123. Some of those items that will be tweaked, obviously, for the next time. Certain years you're going to have more expenses, like the actuary. We had several cost studies and things that we did during that year. The administrator, we did have a fee increase, which we hadn't budgeted for the year before. So we'll tweak some of those things. But in general, we were pretty close on our budget. The overall, only $17,000 difference is pretty on point. So I can discuss any issues you have with that, any questions. Otherwise, I'll be looking for a motion to approve the actual expenses as presented.
Johnson, move.
Okay. Motion to approve.
Second.
And second.
Second, Tom.
All in favor? Aye. All right, moving on to trustee terms. My member elected expires March 1st.
Would you like to serve again?
Sure. Do we need to do any kind of vote or anything?
All I'm going to do is we will get the notice together. A nomination notice will be sent out to all the members, all the police and fire, and then if nobody runs against you, you'll automatically continue to serve. If somebody does run against you, there'll be a runoff. We'll have all this done before the next meeting.
Sure.
Okay.
Yep, that sounds great. Do we need a motion for that?
No.
All right, and then moving on to the approval of minutes from our last October 28th meeting, 2025. And we just need a motion to approve those minutes.
Yes.
Motion to approve.
Okay, Tom.
Second.
All right, all in favor?
Aye.
Aye. All right, perfect. Moving on, I don't see anything listed here under old business. And for our reports, being Doug Lozen is running a little bit late, Brad, do you mind bumping up for Mariner Institutional and giving us your quarterly report and the real estate and plan history presentation?
Absolutely. Good afternoon, everyone. So, trying to get to the tablet if you guys are there. Thank you. So the cover of the quarterly report starts on page 48 of the tablet if you're there. If not, it's the hard copy that I sent out. So I have a few things for you. One, our quarterly report, fourth quarter of the calendar year, first fiscal quarter that we'll go through. Right after our meeting last quarter, there was an article in the Wall Street Journal that I shared with you all. I gave it to Troy to share with you all about our real estate investment, particularly with Intercontinental. We have two. They didn't mention the principal one. Well, we've been doing a lot of discussion, obviously, over the last couple years on this, right? And one of the things that came out when we had the extended discussion last quarter was that no one on the board was around when this investment was made in 2017. So I put together a presentation that just lists out all of the actions with the real estate since we started it. I got all the historical minutes to give you a historical perspective of, okay, what was the decision making like of the board back then? Why did we put it in? What was going on at that time? What our experience has been? And then what are some of the reasons that we kind of, suggested it? Why did we invest in it? How it ended up doing? And then also some of the reasons, we've had discussions about private real estate versus REITs, so I wanted to provide you some perspective on that. So we'll get into that as well. Be happy to, I've had some conversations with, after the last meeting, shared this with Trustee Van Deventer, and had some feedback from him that was incorporated here, so I appreciate that. But I thought it would be great discussion for the board just to kind of finalize this. It's becoming an increasingly smaller part of our pension, right? We just put in a large redemption, and we actually received all of the money that we asked from principal a few weeks after we asked for it, because they cleared out their redemption queue. But in any case, and also, if you remember last quarter, I brought some global bond managers for you guys to consider. And then there was some feedback of, okay, let's take a step back. So I found our educational primer on global bonds to go through, what it is, how it might, add to the pension, so we can have a more informed discussion about that if you choose to. I know that you have Doug coming in as well, so maybe I'll check your temperature when we get to that part to see if you want to do that this meeting or hold off on that. So, sound good? All right. So let's go to the quarterly. It was a decent quarter for the pension after two kind of really strong quarters in a row. It was, I guess, more measured, but positive. If you flip to page 2 and 3 of the hard copy, and you can just focus on 51 in the tablet if you're there. You can see on the upper right-hand side what happened in the quarter. 2.7% for the S&P 500. International stocks continue to do really well, so they were up 5% for the quarter. Bonds kind of just eked out. It was fairly tame from a rate perspective, so about 1.1% in red in the U.S. aggregate bond index. And then you can see for the year, so about an 18% return for the S&P 500, so 3 tremendous years in a row. To remind you, 2023, 2024 were both 20+% return years. We didn't quite get to the 20% mark, but 18% is well above average, so it's really been a strong run for the S&P 500 here. One of the things we haven't seen in a while is on the lower right-hand side, those returns for international equity, 32+% for international stocks last year. Both the stocks a little, but also the currencies, right? The dollar weakened. We kind of talked about this in the past, and that really helped, kind of amplify the returns for U.S. dollars and international assets last year. In the quarter, we had 3 interest rate cuts by the Federal Reserve. They meet today and tomorrow. We'll see what they do. It doesn't. The futures markets aren't pricing in them taking any action, but I think I heard it was a 40% likelihood. So we'll see what happens there. The economy continues to grow. I think one of the things I find interesting is, I don't know if you've heard this term, but they have the misery index, right? It's you add inflation plus unemployment, and they call it the misery index, right? If both of them are high, it's not good for people, right? So right now, inflation's at 2.7%, unemployment's at 4.4. So that 7.1 figure is actually in the 25th percentile over the last 50 years. So 75% of the time, that number has been higher, so things have been worse. The University of Michigan puts out a consumer confidence survey, and that number, and I think it's 52 point something, and I forget, I can get to the actual number, but that's in the 95th percentile, meaning that 95% of the time that figure has been higher. So there's been more consumer confidence, even though things are relatively good from an economic perspective, and certainly from a market perspective, right? We've had 3 incredible years in a row. I think that kind of speaks to, one, there's inequality. A lot of economists talk about the economy being K-shaped, and the haves are doing really, really good, particularly with asset prices, but the have-nots are kind of struggling because while inflation is 2.7%, if you think about from an aggregate perspective, prices are 20+% higher for that basket of goods versus pre-COVID times before inflation started rearing. And then you have obviously social media, political, all that stuff. But on the whole, I think, things seem solid from a growth perspective. Things seem solid from a corporate earnings perspective. One of the things last year that I saw was, about 80% of the return of the S&P 500 was driven by earnings growth as opposed to multiple expansion, which is kind of a healthy thing. If you look at the 2 years before, particularly 2023, it was the opposite. 80% of the return came from the market valuing earnings more as opposed to the actual earnings growing. So I think that's a positive sign. You have some good things going on in terms of taxes. So lower taxes. Americans should be getting a much larger tax rebate this year that should help boost consumer spending potentially. But then there's obviously a lot of Greenland. There's a lot of geopolitical issues. We still have wars, all of this stuff. So, I'm thankful that I don't have to time, tactical day-to-day moves in the market, right? We're managing a pension. We're built to withstand whatever happens. The environment seems decent, but there's always potholes. One of the things is the second year of a presidential administration historically has been the lowest returning year of the four, well below average. I think there's some midterms and all of that stuff that's coming up. So there's a lot of stuff out there. I think we've been good with being consistent and disciplined over time, and sticking to a long-term focus, which I'll certainly be a proponent of continuing to do. Any questions about what's been going on, generally speaking? If you flip to page 4, just one thing I wanted to highlight, because this is, it's early this quarter, obviously, but it's continued this quarter. We had a lot of talk about the Magnificent Seven and growth stocks doing so much better than value stocks. Had a little bit of a breather for those Magnificent Seven stocks in the quarter. You can see in blue are the value indices, and in red are the growth indices. So, small win for value last quarter, and that's continued this quarter as well. Small win for value stocks, as the kind of S&P 493 have done a little bit better than those Magnificent Seven. So let's highlight that as well. Let's go to page. Go to page 14 of the hard copy, and that is
62.
62 of the tablet. This shows you side by side, left-hand side is September 30th, right-hand side is December 31st. So we went from $21.16 million to $21.44. And you can see the allocation below. Notice, the real estate went from 7.4 down to 5.3 as we got some of the proceeds from, our requested redemptions in. I'll note the cash was a little high as we received those funds. Now it's a little bit lower. It's under 700,000, which is still above our target. But I just wanted to note that I was going to potentially make a recommendation when I saw that, but I reached out to Troy, and it sounds like we have a few lump sum distributions coming down the pike over the next couple months, which we'll have several $100,000 being requested from drop or members, and so I think it's prudent just to keep that a little bit above average so that we have cash available to pay those out. If you flip to page 17 of the hard copy, 65. This shows you our current asset allocation percentages relative to our IPS targets. So we're within policy limits for all asset classes, so we're not outside of policy. Maintain, a little bit of an overweight to domestic equity and underweight, obviously, now to real estate now. I'm not recommending a rebalance this quarter. I think we're okay for now, and we'll reevaluate that next quarter. And then next page, 18, shows you all the activity. So you can see net transfers, we received that money from the real estate manager, so we got all 400,000 of the outstanding queue that we put in, I guess, in October last year, so we got that by the end of the year.
What was the, I guess the rationale behind that? I know, did the company discuss that, Principal?
No, I don't think they don't have as much in their queue. They as you, just to remind the board, right? We put back 3 years ago now, we asked for 150,000 from both of them. Principal was had much more liquidity in their portfolio than Intercontinental, so we had already received all of that money. So I don't think they had much in their redemption queue where they were able to just use the existing fund cash flows to pay out the little bit was there. Intercontinental, a little bit different story. I think they have about 15% of their NAV is in their redemption queue, and we've kind of talked about their portfolio a little bit more in office, and I think some of the issues there that they've had with they've only been paying out 5 to 7% of their redemption queue. Now they say their plan for this year is they believe they're going to be they'll have more liquidity as based upon the markets, et cetera, and they anticipate spending out more, but we'll see if that's actually the case. At least that's kind of what they stated in their letter, that their plan is to try to increase those amounts as the real estate markets have kind of stabilized more over the last year or so.
So for Principal, we don't have any further requests from them at this point, or
Correct.
do we? Okay, and then for Intercontinental, how much is outstanding? Do we know that?
I have to go look. So we asked for an additional 350,000. And then I think that we had, let's say we had somewhere between $50,000 and $75,000 outstanding of the original 150 that we asked for a couple years ago. I think we got about between half and 2/3 of that back so far.
And anything in addition to that, we're still waiting on?
Yeah, so the 350 plus, let's say 50,
right.
They owe us 400,000.
Okay.
Yeah, ish. Any other questions on that?
Not right now for me, thanks.
All right, so you can see 219,000 and some change in contributions from members and the town. We paid out $271,250 in benefits, about $6,000 in investment management fees, and $36,400 in other expenses, and then income and dividends of $400,000. So that capital appreciation of negative $26,000, 21.44 at the end of the year. Then page 20. So for the quarter, we were up net of fees 1.74. It was a little bit behind the policy index, in line 1.9. We don't, when we ran this, we didn't have the universe numbers, but we got that subsequently. I think the median that I saw was 1.95, so a little bit under this quarter. Largely due to our equities and specific the MFS Growth Fund down 0.7% versus up 1%. So underperformed again. It's been a tough go here. One of the things, I have a couple thoughts here. One, just for information, last quarter and last year was very, very hard for active managers. I saw Jeffrey's report that said it was the worst year for active managers in history, as you had these kind of sharp, low-quality rallies, particularly post Liberation Day, right? You know, that being said, it's hard to keep justifying having this fund when it keeps underperforming and we're paying an active management fee, right? So I understand conceptually, okay, you know, it was hard for active managers to win last year. But at a certain point, and you can see over the long term, you know, 5 years are about average, a little bit below average, but well under the index. So, you know, I can't sit here and have very strong conviction that, you know, the future is going to be better than the past here. So there's two things that I think you should consider. One is terminating that fund and just putting the Vanguard Growth Index, VIGAX, in there. You get cheap market exposure to growth funds. You know, downside there is that, you know, that's very concentrated index now. You know, the top 5 holdings is 50+%, but it's been incredibly hard over, you know, not just now. If you remember a few years ago, I did the kind of educational piece on indexing active versus passive when we made the large shift to put most of our money into indexing, and not just in recent time, but over time, it's very hard for the growth index managers to beat the growth index. So that's one thought. So where we can have, you know, the core of our money, 80% of our domestic equity would be in the S&P 500 index fund, and then you would have some money into a value index fund and some in a growth index fund, where you can kind of maybe potentially take tactical bets if you had a strong feeling one way or the other. The other thing is that we can terminate Vanguard, value index, and terminate MFS growth and just put it all in the Fidelity 500 index fund, where that's what our policy index is, and we kind of just ride with that going forward. I can see an argument for either of them. I wanted to bring it up to the board for discussion, but I do think at this time, you know, it's hard to justify keeping that MFS growth given the continued underperformance that we're seeing with that one.
Why don't we come back to that, okay? Just like, we're gonna go through this, finish this.
Sounds good.
Okay.
Page 21.
Yeah, let's see the full picture, I guess, right?
So page 21 just goes into our fixed income. See, Managed Peer was, you know, in line with the index, up about 1%. Aristotle and PGIM did a little bit better at 1.7 and 1.4. All in line with expectations. Page 22 gets the performance of our real estate. Intercontinental, you know, slightly negative. You can see the we did at the time of publishing, we didn't have the index data here, so that's 0. We'll add that when that information gets finalized. But the principal fund up 1%. Both of them, you had slight capital depreciation in the valuation for Intercontinental. Principal basically flat from a capital appreciation / depreciation valuation perspective, and you kind of just got that income fund. That's what we've been doing over the last 4 quarters. You know, we had this 20+% decline in those commercial real estate markets over the last, you know, 4 or 5 quarters or so. It's been pretty flat for valuations, and you've just been kind of collecting the coupon for the most part.
So just to dig into that just real quickly, your 1-year number, you have the benchmark there, right?
So that's not going to include that's carrying a 0 for last quarter.
Okay.
Does that make sense?
Right. But
So
the top line, the 1-year number is actually the so that ends last quarter. It's not current then, right?
Right. So
You have a lag effect there.
yeah.
Okay.
Yes, sir.
It might be good if you footnote that in the future.
Okay.
Right, so just because we're going to be coming around to this later, the inception performance on a lagged basis, that would be lagged also, right? But from inception,
It'll just be carrying a 0% return for the last quarter,
right?
correct?
Right, but it's 276 versus for Intercontinental versus the bench, which was 321, and principal's 355 versus 342, right?
Correct.
Yeah, okay. And the 1 year, so the 1 year number you're showing for principal there is actually is a current number, not for the bench, but for the number.
So the principal and Intercontinental, both we had quarterly returns, so those are the numbers for the 1 year, and all of those numbers will be,
Right, yeah.
is not missing the last quarter. The only thing that's missing is the NICREEF is holding last quarter as its zero.
Right. So those really aren't comparable numbers. You got apples and oranges mixed in there. Yeah, I would definitely footnote that.
Yeah,
That's misleading. Yeah. Okay.
You're better off looking at a bond index, current.
Not always.
As a comparison.
I'll make sure that we have that up there.
What was the, because we don't have an attribution, what was a problem with MFS last year? I think we discussed this at the last meeting, didn't we?
Yeah.
They had an under allocation of something.
Yeah, so, if you looked at
Versus
their
the
overweights, I think they were underweight Apple of the big ones.
Right.
And they were overweight Amazon, and they were a little bit underweight Alphabet, and particularly last quarter, Alphabet was like the only
Right.
Magnificent Seven that did well. So that hurt them. So it was largely driven by that. They have exposure to all those names, but like for example, Apple, I think they're half weight. I think the index is at 12 or 13, and I think they have about a 6% weighting or so the last time I looked.
Yeah, personally, I don't really have any skin in that game. I would say we just default to the bench. I would like to see us remain active, just a slight active, but we're basically fully benched now at like 3/4. So, 3/4 to 80%. But I think we keep, 1 foot in the value index and 1 foot in the growth index. But we haven't had much luck, we made a good decision to go to index benching, a long time ago. And I think we haven't had much luck with our growth managers yet.
Yeah.
Yeah.
But
Yeah, no one has. You can see where they rank in the universe, right? It's just
Yeah.
it's been a top decile performer
Yeah.
over basically every time period. Yeah.
I think we just go to the default there. That would be, unless you guys. What are we paying MFS? What's the?
I think it's 0.5, but
What's the fee? Like
0.49. It's on
50,
page 27.
50, and what's the Vanguard? Like 11 or something?
No, let's see.
Right.
I think it's less than that. I think it's 8, but let me double check what VIGAX is.
Is that cheaper than than IWF? Which is the I think State Street. Also 1,000.
0.05% for VIGAX, which is the Vanguard Growth Index.
And do they use Russell? Are they defaulting to Russell 1000, or are they using?
No, I think that's
They use
the
their
total
own.
growth. So that's more of a total growth as opposed to the Russell 1000 growth.
Right.
Index.
What does that mean? What benchmark are they using? Because if that were the case, I don't think we would have to consider changing the benchmark.
So Vanguard doesn't like the license from
Nobody does.
Russell.
They charge too much money.
So they're doing the CRISP U.S. Large Cap Growth Index as the prospective index that they're basing it off of now.
What's the correlation between those two?
It's going to be really high, but there's going to be some times where there's slight differences, right? I don't have, I'd have to run the data for you if you,
I mean, my firm, we're not paying Russell anymore. I still use Russell, but Russell 1000,
I mean,
right? But our firm doesn't because Russell's charging so much money now. So I pick it up on a daily basis off the IWF, which is the Russell 1000 Growth ETF. I wonder what does that cost versus,
so so VRGWX, which is the Vanguard Russell 1000 Growth Index Fund, iShare.
right? Not iShare.
We won't be able to get access to that actually, because that's a
But
fund.
that's an institutional share.
Maybe we can leverage, that's 6 basis points. Let's see what the ETF is. So I have VONG as the Vanguard Russell 1000 Growth ETF, and that expense ratio is it's 7 basis points, 0.07%.
And that's versus the 1000 Growth?
Yeah.
Yeah. So I would say for right now, we just default to that. How much, what's the assets in that?
Like how much they're managing in that ETF?
Yeah. That's just for an indication of liquidity. Yeah, I would imagine. Just looking up iShares while you're doing that. iShares fees are 18.
I can't see on I'd have to dig into Morningstar to get you what's in there.
Well,
I'm curious, is there a reason that you prefer the ETFs over the institutional mutual funds?
no, no, I would say no. I'm looking at, but I'm just comparing costs. So the total expense ratio of the iShare is 18 basis points. So the Vanguard comparable, was that the management fee you gave us at 7 basis points?
Yeah, for
total?
VONG, which is the Vanguard Russell 1000 Growth ETF. That's
or is that the
0.0.
full expense ratio?
That's the full. It's 0.07, so
Right.
it's cheaper than the iShares.
Yes.
And then the V. And then, but if you go into the Vanguard Russell 1000 Growth Index, you save 1 basis point.
If we can get into it, right?
If we can get into it, and then
Okay.
VAGIX is 5, and you save 2 basis points, so because you don't have to pay for the Russell licensing.
Cheaper is better, all things being the same, right?
I like VIGX. It tracks the growth index. It's the one that I use in my clients because it's the cheapest, and I don't see much of a difference between the returns for that relative to the Russell 1000 growth. So I've always defaulted to VIGAX because it's the cheapest, and you're getting the same structural exposures there.
I mean, since we haven't made a comparison, I mean, I'm just going to say, like, so, I mean, at my own firm, they're using the Bloomberg Growth Index, but actually over time, there's a lot of tracking error versus the Russell 1000 Growth. So I think that almost makes us technically have to go make an evaluation of that, and we probably have to get back into guidelines and everything, and all. So I guess I would motion that we just take the Russell 1000 comparable, the cheaper institutional share, the Vanguard share, and just default to that.
Okay.
Right? I mean, we're going to be saving 41, 42 basis points in fee there. So
Yeah.
And you're talking about for replacing the MFS growth?
yeah.
And then,
Just get the monkey off our back because we've been
Right, so if we-
we've been fighting this battle now for like 3 years, with these guys.
should we,
Yeah.
Excuse me, gentlemen, I'm sorry, Jim Morgan, Town Manager. We're recording this public meeting, and it's also being live streamed to the greatest extent possible. When you speak, if you could bring the microphone forward and speak into the microphone, it's just critical because we're listening to it, and we're having a lot of trouble hearing it. So if you're talking, just please make sure the green's on and lean forward and get into it. And if not, that's fine, but we were just having trouble hearing it remotely. So thank you, and I apologize for the interruption.
No problem.
Very sorry about
Nope,
So I was just thinking that if we're gonna be making that change, should we rebalance the total equity, or at least be aware what the allocations are? Because basically what it would be approximately 2/3 S&P 500, and then 16%, so, in growth and 16% in value. So the growth value
They're about equal.
allocation, about equal, I mean, or equal them up, or just, I don't know if we need to worry about that. It's a couple $100,000 differential.
I don't think so.
Okay.
I mean,
MFS growth.
and I looked at the, Brad, the last year's end of year, December 24 commitment to equity was about where we finished this year. So just in terms of total allocation, because we didn't kind of hit on that, I think we were around 65.5%. Yeah, December 24, we were 65.7% in total equity allocation as a percentage of the total plan assets, and we finished December 25 at 65.25. So we were actually net down. So, I mean, I don't think we need to propose, are you not proposing a change in allocation to equity, are you?
No. If we're going to keep with 3 funds and we
Right.
want to keep a value fund and a growth fund and the core fund, then I'm not, I think we're, like, when I look at the, the allocations,
Okay.
I think we're, you just did the math, right? That's kind of where we've been, and I don't have an issue with that. We haven't gotten too far over our skis in either growth or value to need to rebalance that at this point.
So going back, everybody ready to I'll make a motion that we just move the MFS money to the Vanguard Institutional Large Cap Growth, Russell 1000 comparable, if we can get into it. Otherwise, we go into the other share, Brad, which was the 7 basis point share.
That would be the ETF,
Right.
VONG.
Is that the Russell 1000 growth as well?
Yes.
Yeah, okay, good.
So
That's the motion then.
And what was the symbol for the first one?
yeah, so that's so the institutional mutual fund, if we get into it, is VRGWX.
VRGWX?
That's the Vanguard Russell 1000 Growth Index Fund institutional share.
So selling MFG growth R6 and putting all into
Yes.
VRGWX.
And the backup was, again, what, the alternative? The ETF?
And if we're not able to get into that, the ETF is VONG.
I'll second that motion.
All in favor?
Sure. You want more discussion? I'm sorry.
So you're content in jettisoning the active management structure?
So just to be clear, right, this,
You can always come back.
there's
True, no, you can always come back,
None of these are
absolutely.
actively managed, right? So
Yeah,
we're just,
so
we're either, we have 3 index funds now, one, the S&P 500 core, one would be a growth index fund, and one that we have already is the value index fund, right? So just so everyone's clear, we're getting out of the active management business for our domestic equity.
that's what I'm-
Well, that's what
That's
Fred
what
is
I-
asking. Fred's confirming that we are
Yeah, exactly.
bidding adieu to active management.
Yeah.
I'm voting against my entire career.
So
I'm waving the white flag, getting the monkey off my back.
or active
I've been on both sides of this table,
active managers bad, or did we just
but I was outperforming.
choose the bad active?
Always.
manager?
So, yeah.
Is it active managers, or is our selection of active managers?
Our selection.
It's hard to do. It's hard to do.
Exactly.
Hard to do.
I mean, it's hard to make a case.
So I think the motion is still active. Right?
Yeah,
Okay.
definitely, yeah.
Any more
It's just
discussion? Or I guess that's
Right, yeah, so we have the motion. And we have the second. No more discussion here. All right, all in favor? Aye.
Aye.
Okay.
All right. Any other questions on the quarterly report? Was it real estate? Yeah. Oh, okay, sure. All right. All right. So let's go to the real estate discussion. So this is on just a smaller presentation for the handout. It says Indian River Shores PSO Fire Private Real Estate Review, and it's 122 of your tablet if you're on there.
I have it.
All right, so flip to page 1. This is just the timeline and goes through all of the actions taken with this, starting in January of 2017. So at that meeting on January 31st, the pension board at the time reviewed an asset allocation study. We were retained, I think, at the end of, in December of 2016 when I looked at the original agreement. To be the investment advisor. So we did an asset allocation study, kind of reviewing what are the assumptions, where we're at, where things should be, right? And we've done this, it's been a couple years, but we've done it periodically for you all since then as well. But you know, among other things discussed in that is that we basically at the time we kind of said, you know, observed, you know, fixed income, decent returns historically, but given where interest rates were at the time, going to be a struggle for fixed income in the future. And then because of you know, your best guess for what you're going to get out of fixed income is your current yield in the portfolio. And you can see the chart, I kind of ran it here back in 2017. This is the 5-year treasury bond. But you can see, you know, when the decision made, you know, the 5-year was basically under 2% for that entire time period and for most of the couple years before that. And then we, you know, highlighted private real estate as, you know, given the mostly income-oriented return structure as an alternative for potential consideration for a, you know, a yielding type of fixed income alternative, right? So,
Can I just say one thing there? I think some context would be helpful there. Now, we've changed our allocation guidelines since I've been on this, you know, on this board. And we've kind of upped the range for equities, but at that time, there was a lower assumed return, I think, but the 10-year and the 5-year were, as you said, you know, 2% arena. So fixed income was not within an intermediate term maturity and a long term was not yielding, was not even making. You know, you were, you know, after inflation. Of course, we had low inflation then, but the assumed return, it made complex math, Brad. I think if you could give some context to how, probably, I'm assuming that the board that was what they were considering at that time.
yeah, so I don't have the numbers in front of me, but right, when you do an asset allocation, you kind of plug in, okay, here's your return assumption, and at that time you're correct, right? We were at 6.25 at that point. But still, you know, when you have 60% equities and when you're using, you know, depending upon what your assumptions are that you're putting into the model, you know, you're going to look at, you know, the return expectation for fixed income at that time over a 10-year period is going to be in line with what the 10-year treasury was at. When you're right, it was around, you know, probably a little bit higher than the 5-year, but still below. So if you do just 0.4, right, 40% of what that return expectation is, you know, you're getting, let's say, a little less than 1 contribution from your fixed income
right,
part. Right. And then if you do 0.6, and let's say at the time, I don't know what the numbers were, but maybe it was, you know, you would expect 8 at the time, because, you know, probably a little bit discount from the historical level. But you're not quite at your return assumptions. So it was like, okay, how can we fix this and provide some sort of, you know, is there a vehicle that we can invest in that you can get a little bit better return, provide some diversification benefits, which we'll get into here further.
Okay.
And that's kind of where the conversation was. So at this meeting, the decision was made, so we'll investigate this and we'll get some education on real estate. Well, this is the board at the time, and you can see further along, page 2 gets into the next kind of part of this. So the next meeting, April 24th, 2017, we produced, you've seen a version of this where we do a manager analysis, right? We list out a couple of alternatives. You saw one last quarter that we didn't really get into that much with the global bonds, but it would be funds that have been fully vetted by our research team that we think are high quality funds that are out there. The board reviewed this analysis that went through, firm and product characteristics, the differentiators and how they're allocating capital, all of the terms, including liquidity characteristics, and the limited liquidity in terms of particularly relative to the other investments in the portfolio, which are daily liquid, and then went through historical performance and risk stats, et cetera. There was also in this meeting representatives from each of those firms. So the board at the time interviewed 4 private core real estate firms at that meeting after they reviewed the information from us, the ANCO at the time, now Mariner. And then after that whole process occurred, the board voted to allocate 10% of the pension at the time to private real estate, with the source coming from its fixed income, core fixed income allocation. And they selected, basically they split the allocation half to principal, half to intercontinental after that process. And then in September 20th, the board approved an updated investment policy statement that codified that decision and added the 10% strategic target to private real estate with a corresponding reduction to the fixed income.
And that's still in the investment policy statement, and is it 0 to 10%?
Correct.
Confirming that, that's what I thought, thank you.
Then, and then January 2018, both of those investments were funded. Any questions about this so far? Okay, page 3. Kind of fast forward to 2022 when things started to go south. But from 2018 to 2022, this was a really good investment for the pension. You could see from January inception up until 9/30 of 2022, and particularly relative to the fixed income source of funding, very good returns. At that point, if you just took a snapshot of the inception returns as of 9/30, 2022, Intercontinental up 10.8% net of fees, Principal up 9.7% net of fees. The Bloomberg US Aggregate Bond Index returned negative 0.4% during that time period. And then particularly, we've talked a little bit about this, right? That really tough fiscal year 2022, which was the worst year for pension funds since the financial crisis, as stocks were down 15%, bonds were down double digits. The real estate really helped protect capital in that time period, as private real estate prices increased during that time, and you had roughly 20% returns for both of those funds during that period.
Well, I would just add, I guess my interpretation of that was, the Fed was tightening, very rapidly during that period of time. So that collapsed the, I think the low on the 10-year was 50 basis points or something. And,
Right.
Recently, and I don't know where we ended up at 5 or something. So, the benefit actually of the private real estate during that period of time is kind of the yin and yang of its demise subsequently, which was that it wasn't getting marked to market necessarily properly. So because of the lag, effect of the value. But you'll also recall we had kind of twin headwinds then, because we also had the work from home craze start with in early 2020 with COVID. So real estate, mark to market real estate, it was choppy. So I'm just,
But yeah,
I'm just
so 2022,
kind of throwing that out because when
2021 was a great year. So I think the
Right.
larger, so it kind of, you can get the kind of appraisals, right, for like the companies or the properties during that time. I think if you looked at any industry publication at that time, prices were particularly industrial real estate and multifamily during that time, because there was a shortage. Office was not doing well, and getting much worse starting in 2022, 23. But particularly industrial, the Amazonification and all the boom with that. The prices of those were going up a lot, and that was also reflective in reprices, particularly in 2021. But because of the high correlation of REITs to publicly traded equities, you saw a disconnect between valuations of private real estate and REITs, particularly in 2022 market downturn, right? Okay. But your broader point is correct. Like when you look at so why own real estate? You have, particularly at the time of investment, above average yields that you're able to get from rents, and diversification benefits is the next, which we'll talk about in terms of the correlations to publicly traded stocks as well as fixed income. And then the third kind of leg of the stool is inflation protection. This goes back historically. Real estate tends to do well in inflationary time periods, and that's exactly what you saw in 2022 as inflation started roaring. You had this, it did well in that time period. So I think broadly speaking, I definitely agree with what was going on, like on the ground, and what caused some of these returns. So proactively in July of 2022, that meeting on the 26th of July, prior to the kind of the high water mark in September, we got over allocated, and I recommended it, and the board approved putting that redemption in, that $150,000 redemption, to try to get some capital out of that investment. Unfortunately, the timing was the market started to turn right as we kind of put that in, and then our money was basically, we got drips and drabs out over the next couple of years, but the liquidity characteristics dried up, and we weren't able to get all of that money out ahead of the time, and it took some time to get that. And then other actions the board took, January 24th, 2023, that's when we decided to turn off the dividend reinvestment features of those funds to get the income wired to us as opposed to reinvested back into the funds. Any questions about that? All right, page 4, and I kind of discussed some of this stuff, right? But just, so real estate market peaked in September of 2022, and then had basically there's been 3 market downturns. Financial crisis of 2008 was just an implosion where you had a 40+% decline in the NYCREIF index. But you had the early 90s saving and loans, and that one that was similar to what we experienced in 2022-23. You had basically a 20-25% decline in real estate values for the NYCREIF Fund Odyssey Index. One of the things that we talked about a lot is the liquidity characteristics, right? So the stated liquidity characteristics for private funds are quarterly withdrawals or additions, but they have the feature during times of trouble that they can limit the ability to pay out redemptions, right? And that's basically all funds have did that starting in late 2022. And yeah, you can see the figures of what we received as of 9/30/2025. And I should note that, right, I didn't have all of the 12/31 data when I put this together a couple weeks ago, so everything is run through 9/30. I should so highlight that. But you can see, you know, we got all of our money from principal. It wasn't all at once. It did take some time, and we still do have, you know, roughly about half of what we asked for initially from Intercontinental. And then last meeting, October 28th, after that, you know, long discussion that we had, we submitted those additional redemption requests to principal for $400,000 and Intercontinental for $350,000. Does anyone have any questions? So that's kind of the historical backdrop of all of the actions the board had taken regarding these investments, and at least somewhat of a rationale of why it was taken back in 2017. Any questions from the board on that?
Only with this history, I just want to, I guess, ask about the most recent. So principal, we put in what is now looks like a full liquidation request of $400,000 because there's $325 remaining.
No, so we had 750.
Okay, so the 400.
Yeah.
Okay, I'm sorry.
So we put that in, you know, whenever a week or so after, and then they did their math and said, hey, we're going to pay out our entire queue, including the money you just added to it.
Okay, so that was recent money as well, the 420.
Yes, yes, sir.
And so we don't have anything outstanding, as you'd mentioned.
Not with
them.
principal.
And so we could, I mean, we don't know if we had requested more, whether we would have gotten more, or do you know if the gates are just totally open at principal?
Yeah, I mean, so so if you, I think it's safe to say if you would have put a full redemption in last quarter, that you would have gotten all of that.
Okay, just curious on the going forward.
Yeah, I mean, it's hard to say if like that additional 325 would have tipped the scales for them not to pay out full, like, but I think I'm safe to say like that wouldn't have really moved the needle that much for the redemption queue. So yes, I think if I'm speculating, you probably would have gotten all $700,000 out if you asked for it last quarter.
I'm just thinking about BREIT, and everyone knows BREIT, Blackstone's real estate trust, and they face the same thing. They put gates up, but I don't think there's any gates left. And they also borrowed money to make sure they could make redemptions, but it seems like principal's doing the right thing, seeing liquidity, but I don't understand why Intercontinental is just taking so long.
Yeah.
And why don't we even consider a full redemption request with them? Or I guess that's a bigger question. What do we want to have in terms of a allocation of real estate?
Yeah, so I think it's a fair question. One thing I didn't put in here is that we actually had Intercontinental come present to you all. I have to get the date that was not here, but you did hear from Tim Nash came and spoke to the board, I think sometime in 2024. I'd have to go back and see what exactly the date was, and I just remembered that, so apologies for not including that in the but yeah, so I think basically, you know, their official position is that liquidity conditions do not warrant, and they don't believe it's in current shareholder interest to go out and sell those buildings to raise the liquidity to pay the redemption queue off. And that's basically what they're communicating right now.
Yep. But, and I neglected to mention, this history is very helpful. Thank you for tying that all together.
No, it's my pleasure, yeah.
Brad, do you know what was our position relative to the total position of the partnership? How big originally it was?
I mean, it's very tiny, so I know.
It's very tiny, right?
I'd have to get the updated numbers, and I could probably find them for you if you give me a few minutes after I go. But I'm going to say that Intercontinental has somewhere between $8 and $10 billion in the fund that you're in. So I'd have to do the math, but at one point you had $1 million-ish, right? So you get 1 million divided by 9 billion. So that's what percent of the fund you are. So it's less than 1%.
Peanuts. Okay.
If you don't mind, board, there's been a request for a guest speaker who's a former board member that wanted to just do a quick discussion of this real estate. Sir.
Sam, can I just say one thing before you start? I just wanted to add, because I think
Just get your mic.
context here, just because I've been in the business too long, but you know, real estate investments, for the rest of the board, if you haven't been familiar with real estate investing, institutional investments, I mean, number one, I don't know what the institutional allocations were at the time in 2017, you know, across public real estate, you know, Florida real estate, comparables, pensions, profits, all those things. But historically, you know, I talked to Brad about this over the last 3 months, and I think that I took issue with the article which was published by Jason Zweig in the Wall Street Journal because it did not include what we would deem to be in the investment business a full cycle, and a full cycle generally includes, you know, a bear market and a bull market, or a bull market and a bear market. And in real estate, we tend in private real estate, you know, these are not, you know, marketable securities that are secured by real estate. You know, those kinds of cycles, if you think back, I mean, sometimes they run in 7-year, you know, to 12-year time periods. And we don't, Brad, I don't think you're presenting data on that shows what real estate cycles are historically, but the numbers that were presented in that Wall Street Journal article were like, you know, a time period which was certainly not complementary to the pension board, you know, and the selection, you know, because it was a 5-year cycle, ended, I think, in December of 24. So, you know, I think what Brad has presented, at least in the first part before Mr. Carroll speaks, is basically that we had a really nice return, you know, relative, and that the allocation to real estate actually provided, I think, the objectives that were determined by the board at that time, but even more than that, they were kind of half a cycle. So, and you know, we'll come back to these numbers later, but when we look at the risk-adjusted rates of return, and those are really important numbers because they actually demonstrate that we've had, you know, a positive risk-adjusted rate of return over the full cycle, which Brad has prepared. So, I give up the floor.
You stated much more eloquently what I was going to say. My name is Sam Carroll, 91 Calvary Lane, Vero Beach, Florida. I'm a current member of Indian River Shores Town Council, and prior to being elected to the seat in 2018, I was a member of the pension board. And I sat in the seat where Mr. Van Devender is sitting now during the time that the decisions were made to invest in real estate. And I can attest, based on my general ability to recall pretty accurately what was said, how it was said, how it unfolded. Brad, you did a great job of piecing it all together. The article in the Wall Street Journal is a classic hatchet job. It's a hatchet job because the writer, Mr. Zweig, took a short period of time out of context in order to make whatever point he was trying to make about investing in investing privately versus publicly traded securities. Brad said today, and the article stated, that no one was around to comment on, to justify, or to acknowledge why the decision were made. Well, all he had to do was look up the names of the members of the committee at the time, look up the name of the consultant who made the recommendation, and had he been interested in doing that, rather than providing material for what I will call again a hatchet job on the pension committee in the town of Indian River Shores, he could have done it, but he chose not to do it. So I looked up the return, the annualized return on the 10-year U.S. government bond over the period I think I used 2017 to 2025, and the annualized return on the U.S. government 10-year was around 2%. The return that you show here, Brad, for a little bit higher risk portfolio, the Bloomberg, was about twice that, around 4%. Is that right?
No,
Three and
it's
change.
actually lower than that from 1/1/2018, if you go to page 5, Mr. Carroll.
Okay. Okay, so the Bloomberg is lower than that. And the annualized return from the investments in real estate was what during that period?
Intercontinental was 3.1 and principal were 3.7.
Point made. Thank you.
Thank you.
Thank you, Councilman.
It's a good segue to page 5, which was exactly the point that I was going to make, is the last 3 years have been tough for these investments, but we did pick up some nice returns prior to that, so that over, and to talk about, what Tom had said, right, a full market cycle, which includes a bull market and a bear market, which we now are at. You could see on the right-hand side of this page, we go from the 1/1/2018 inception of the private real estate investments, and I just told you what the numbers were. This is again through 9/30, but over 3%, and if you were in either the aggregate bond index or the intermediate bond index, which are on the bottom part of that, you got 1.7 versus, or 1.9. The aggregate bond has a little bit more duration, so more negatively impacted during that down market. But the net result is that the pension is better off, even despite this really tough 3-year period, over the entirety of its experience, by having made that allocation into private real estate versus the alternative, which would have been the fixed income markets. Does that make, anyone have any questions about that? And then page 6 shows you the volatility. We've talked a little bit about this conceptually, but you can see some numbers here. So standard deviation is a measure of risk, right? How volatile your return stream is. These are based on quarterly return series for all of our investments, and also you can see I put the Dow Jones REIT index, the NYCREIF private real estate index, and then the 2 fixed income. If you could look over 10 years, you could see Intercontinental and Principal, both, say, roughly 6% standard deviation annualized over that time period. The NYCREIF a little bit lower than that, 5.5%. REIT index at 18%, very much in line with where you would look at publicly traded equities, and 3 times the amount of volatility that you get in the private real estate. And then you can see the fixed income at let's say 5.5 for the aggregate bond index, and a little bit lower for the less risky intermediate bond index. And then you can see what those numbers look like for the fund, the pension fund's experience in the since 1/1/18, which are in line with that 10-year number. And then page 7 shows you risk-adjusted returns. Sharpe ratio is something that we use that takes your return, it subtracts out the risk-free rate, and then it divides by that standard deviation number. So it gives you kind of a volatility adjusted return measure that you can compare investments. So obviously the last couple years, not great for the real estate funds. There's negative numbers there for the 3 and 5 year. But since 2018 inception, you can see Intercontinental at 0.1, Principal at 0.2, the REIT index at 0.12, and then again, the bond index at negative 0.1 during that time period. So again, both from an absolute perspective and a risk-adjusted perspective, these investments have done better than the source. And on a risk-adjusted basis, while the returns are a little bit better from risk perspective for REITs, when you look at it on a risk-adjusted basis, if you just blended the principal 50% of that Sharpe ratio and 50% of the Intercontinental, we would have done better than the REIT index during that time. Does that make sense? Does anyone have questions of how that's calculated or anything conceptually about that?
Yeah, I just want to add, because we spoke about this, Brad, that I wanted to see the Sharpe ratios and the risk adjusted, the volatility, because we discussed this at the last meeting when we were discussing kind of the pros and cons of private real estate versus versus REITs, which are actually a sector within the S&P 500. Again, they're classified as marketable securities. I mean, really and truly, like you can see from these numbers, they're apples and oranges, right? So by risk adjusting them, Kyle, probably for your benefit, because you didn't maybe I don't know if you studied statistics and all those things, but
no, I appreciate your insight. Thank you.
Yeah, but basically the concept here is when we in this business that we're looking kind of at when we look at just an annualized return over a long period of time, that ends up being like a line, right? Because we're looking at 10 years annualized returns, quarterly numbers, whatever. But when we actually look at the variability of that return, there's kind of a snake going through around that single line, and that measures the volatility. And we use a term called variance or standard deviation, square root of that, to actually proportion that volatility. And so what these numbers actually show, which I think was very interesting, is that over a longer period of time, is that that due to the high volatility of the marketable securities of REITs, and this is something we have to address still because we haven't come up with the answers where we're going to allocate our money, is that on a risk-adjusted basis they kind of come out at the same, at least for the last 10 years, because that can be different the next 5 years and the next 10 years. But they kind of come out at the same place in terms of the what we call the risk-adjusted return of those two. They're two. So I would argue they're two different asset classes. We can come back to that. But private real estate and the marketable securitized version of real estate are different asset classes in terms of the way they act. In terms of their return profile and their risk profile.
Yeah. Thank you, and that kind of leads right into 8 and 9, right? So when you're building a portfolio, a total portfolio, the old adage, you don't want all of your eggs in one basket, right? So diversification is a key tenet of trying to build a portfolio. It's why we have some value stocks, growth stocks, we have bonds, and we have real estate, and within our bonds, we have different types of bonds, right? Because they all tend to move in different directions at different times, and that's a good thing to limit the overall volatility. You limit your potential gains by doing that, right? You would have been better off having all of your money in Tesla, right? But That's very, very risky. Having a diversified portfolio is an important kind of investment concept that we try to apply to the pension. So I wanted to talk a little bit about private real estate and the diversification benefits that the pensions received by having that. And you can see here, so this page 8 just shows you annual, what the returns are each year for, I just did index funds in this exhibit. So it's just the private real estate ODCE index. I did the REIT index, the S&P 500, and the 2 bond index. So you could see, you know, I think it's probably best, starting 2020 is the best useful example. So you see 2020, year of COVID, right? It still is crazy to me that the S&P 500 returned 18% that year when it was down 33% in a month. But so very strong year for the S&P 500. Decent returns for bonds, around 7%-ish. The ODCE, private real estate, flat during that period, but the REITs were down 11% as you had a pretty sharp sell-off, you know, through half of the year, but the big recovery for general equities during the second half of the year, you know, kind of the REITs were left behind, and it was more like, you know, the growth stocks that did really well. But they came back with a vengeance, publicly traded REITs in 2021, you could see, where the Odyssey index up 22%, the REIT index was up 46%, so a tremendous result that year when the S&P 500 was up about 29%. But this is when the fixed income market started to go down, where you had some slight negative results in 2021 for the aggregate and intermediate bond index. And then 2022 is the real kind of, I think, and I've talked about this, so I apologize for beating a dead horse here, but that was the kind of the proof statement of real estate, right? REITs down 26%, S&P 500 down 18% that year, aggregate bond index down 13%, but you got a positive result in the Odyssey index, so helping to stem, you know, protect capital in that year. But then the market turned, obviously, private real estate sold off in 2023, 2024, although REITs did well in those years, even though the fundamentals behind it did not do, I would argue, wouldn't support those types of returns. But they still, because the general market went up, and that's what you'll see is, generally speaking, REITs tend to have a high correlation, I'll show you this in the next exhibit, with publicly traded equities and not so much with actual private real estate and the kind of the you know, which more tied to economic realities, or I would argue that. Any questions about this exhibit? So page 9 gets into that again and shows you those numbers for what this is going back 20 years. So it's definitely a full market cycle going back from 2005 to 2025. So it includes the financial crisis, includes, you know, it's a very representative sample. So you can see, so the way to read this is reading down, basically. So where you see the column that says NYCREIF ODCE, reading down, you see what that 20-year correlation, and again, correlation is what is the strength of the relationship between two variables. In this term, in this case, it's returns, right? So how strongly positive a +1 correlation basically says it moves exactly the same. -1 means it moves exactly the opposite. 0 means there's no relationship between them. So the more you're at 0 from a portfolio perspective, that's good, and potentially negative could be good, but 0 is good, but it means there's no relationship, and then you have like pure kind of benefits, right? So you can see the NYCREIF Odyssey Index, you know, to REITs 0.14, so that was much lower than I thought going into this. But so there's not much of a relationship between private real estate and publicly traded real estate. The NYCREIF Odyssey publicly or private real estate index has a 0.03 correlation to the S&P 500, so no relationship, good diversification benefits. And then to bonds, it's actually been negative over this time period. Again, so when bonds zag, real estate zigs, so you have a negative relationship there, which again provides some diversification benefits for the pension. So publicly traded, because we're talking about REITs, is this kind of statistically shows you one of the reasons that I said I would rather just take that allocation and put it in equities, because you don't get much benefit from a diversification perspective by investing in REITs, where you get that with private real estate. And that's because you can see, if you go to the Dow Jones US Select REIT Index, the correlation to the S&P 500 is 0.74, so a strong positive relationship between those two. So they tend to move in the same direction at the same time. Any questions about that? Does that make sense?
Yes.
And then if I was sitting in your shoes also in this kind of
Right, can I just add, I'm just curious, because sometimes the correlations change over time. I mean, I would think in the last 5 years that the correlation increased quite a bit. Because lots of asset classes have been more correlated over the last 5 years, because we've been through an unusual period.
Yeah, well, I mean,
when the Fed raised rates so rapidly in 2022, I mean, everything went to actually correlated. Fixed income assets, equity assets, everything started moving together. So the markets, various asset classes, like those correlations do change over time. So
they do.
I just point out, we're looking at a snapshot of 20 years.
Absolutely.
Yeah, right.
So what I could do is for next time is I could do a rolling correlation where you can see that over time and see what the changes have been, if that would be helpful.
I think the message here is that probably holds pretty firmly that, however, that there's this anti-correlation between private real estate and all these other.
The only I wish private real estate was correlated more over the last 3 years with publicly traded equities, right? That's the only thing I would say, is that they certainly aren't correlated over the last 3 years, because we got negative results for private real estate, and it's obviously the stock market has been going gangbusters for the last 3 years.
Okay.
But I'd be happy to run that. That's not hard to run, and I can run some charts in Excel or in our software system. But you're right, those things, they do change over time. It's useful to look at, but it's also useful to look at what are the trends as well. And the last page here just shows you, this is based on our performance reporting software, Paris Investment Metric Database, where we get those numbers where you see the total plan universe, where we compare your return versus a national survey. When I ran this, as of 9/30, there was 832 public plans in this sample at this time, and you can see, about 75% of those plans have an allocation to private real estate in their pension. I have additional information that I didn't bring with me. If you wanted to get more, like what is the total amount of money that pensions invest, I can have our research team if that would be useful. But I just thought having one page to show you're not an outlier or doing something that is outside of the normal, right? I think this shows that, the majority of public pensions have some sort of allocation. As of 9/30, you can see the median allocation is 6.2% for those funds as of that date. So we're currently now underweight relative to other pensions, given that we're less than 5% now for us.
The other key point here is, because we've discussed this, to the other trustees here, we've been beating ourselves up, so to speak, because of the illiquidity, the illiquid nature of this. But when I had asked Brad to look at this chart, because if you add up the by its nature, private real estate is inherently illiquid, right? I mean, it's a longer term investment. So when we look at this chart, when we consider alternative investments, and Brad can illuminate us with on other types of alternatives, but hedge funds, et cetera. Private equities here, so alternatives, might be direct investments, could be forestry, things like that, Private equity is 7.5%, alternatives are 9.5%, and real estate at the medians is 6.5%. So when we look at the universe of 832 public plans that are in this universe, the median allocation to illiquid investments is 24%. In that arena, for the edification of everybody sitting here today, I mean, we have about a 6%. 6.5%. So we're basically at a third of what the illiquid nature or our asset classes are in our plan. So this again, kick the can down the road here when we get to a discussion about what we do next. But we don't have a high allocation to illiquid investments relative to the universe in which we would be comparable.
Yes. Thanks. I agree.
It's pretty clear. It made a lot of sense. It's sort of a bond alternative viewed as a long duration asset. And in fact, it's got some real estate, private real estate like that has some inflation hedging component to it as well. Real assets, unlike paper assets. Diversification, cash on cash yields, probably pretty high. So some of these total returns, they mark them violently down. Had you been buying long bonds at the time, we just saw what they did. So, I mean, it seems perfectly appropriate in the context of what your alternative choices were then, and right-sized in terms of balance in an overall pension investment program. So that's how I view it. And then the discussion will come what you do with the, what kind of things you want to do alternatively with the cash.
Well, we went through the real estate presentation, so any other questions, any questions about anything that I just went through?
Oh, well done.
Yes, thank you. I would just like to say, Councilman Carroll and Vice Mayor, I appreciate everybody's passion for this matter in this room. I believe that everybody at the end of the day wants the same thing. I believe we all want a successful pension plan for the people that serve the town of Indian River Shores. I appreciate both sides of the argument because I believe that it gives us a well-rounded view and it helps us try to figure out what the best decision is. And I truly believe that everyone's decisions have been made with the best intentions and moving forward. I just wanted to say, regardless of what anybody says on the outside, I appreciate everybody's work that's sitting in this room today. Thank you. I also think we should hold off on the primer for institutional clients for the next meeting.
All right. Anything else for me from the board?
Thanks, Brad. Thank you, Brad.
All right.
Thank you, sir.
You for your time.
All right, moving on. We'll go back to Foster and Foster. Doug Lowe's, and I appreciate you coming in and making it here today. We held you, and we'll go over the experience study review, October 1 actuarial valuation, and the quarterly member statement costs.
Okay, first apologies for running late, but probably worked out just as well for you to get the important stuff out front. So I've got a couple of items on the agenda. I think we'll first go over the valuation report. And on your tablets, that would be page 11 of 149. I assume maybe the tablets are still working? Or? lit up, so to speak, didn't power down and so on. So I think you're all familiar with the way I like to present. You know, I'm an actuary, there's a lot of details. I'm cognizant that you don't need all of the weeds, I give you the moving parts. So I like to start with words and then draw you into the numbers when you've been prepped for that. There was really, and it's been ongoing for a number of years with this plan, that there's not a big change in the contribution requirement from one year to the next, either measured as total from all sources or whether it's from the members in the town when we split it up. And the reason being the plan remains over 100% funded. And so while pension plans can be complex with all the moving parts, the state of Florida's in this regard made it a little simpler, that when a plan is over 100% funded, and it's governmental pension in Florida, we cannot take a credit from the unfunded liability. So if you're over 100% funded and the unfunded liability is negative, it's a credit, we cannot take that amortization payment as a credit. So really the moving parts from year to year is how does the normal cost change and how do the administrative expenses change. That's really how we measure the change in what the town has to put in for the upcoming year and how much the members have to put in. So again, you're over 100% funded because your investment return was over 11%. We use no smoothing here, so it's fair market value. The bogey was 6.75. So again, still remains over 100% funded. So with that preparation for you to hear numbers, if you go to page 11 of 149 of the tablets, the summary page, you can see that looking at the two columns there, the minimum required is increasing modestly from 18.84% of pay to 19.52% of pay. I say modest, I mean, I know that's subject to interpretation, but it's less than 1% of payroll. The primary reason for that increase is due to the mortality change. When we went over the experience study last year, I advised out of all the assumption changes I was recommending, one you had no discretion on, and that was the life expectancy, because we have to adopt whatever Florida retirement system adopts. That's the primary reason for the almost 1% of payroll increase. So as you're also aware, there's a cost sharing. If the minimum required goes up or down, then there's a share. I'm not going to belabor the formula for it, it's in the ordinance. But the town's piece goes up or down a bit, and the member contribution goes up or down a bit. And so you can see that the member contribution requirement will be increasing from 5.89% to 6.10% of pay, meaning that's the individual checks from the members in the pension plan will be increasing to 6.1%. As a reminder, going back a couple of years ago, it won't happen this current fiscal year. We introduced a projection method, so this is for budgeting for 26-27. So the town, upon approval of this report today, can put in 6.1% coming out of the individual member paychecks beginning with 10/1/26 fiscal year. So when the dust settles, if you go down to the town required, we'll be increasing modestly from fiscal 26 to 27, 12.95% of pay to 13.42%. I'm estimating dollar amounts there just based on currently known pensionable pay. Those are just estimates. The town should actually just plug in the percent and apply it to whatever payroll there is in the applicable fiscal year. So questions, comments on this page?
And this is just not changing the assumed rate of return. This is leaving basically everything the same.
Everything
correct?
the same except mortality.
The mortality, correct.
And the mortality, the increase, I mean, is that still from coming back from COVID? Didn't the mortality rate go down from COVID?
That
and
won't
it's
be
been coming- or not
factored
really?
in. it's no more complicated than the Florida retirement system recommended
That's a number.
new tables to the state of Florida. The state of Florida, the legislators, they're the pension board for the Florida retirement system. Their actuary made a recommendation, they adopted it, so we have to adopt it. Now, I will tell you that it has nothing to do with COVID. This is pre-COVID numbers. It's always a look back. Every 5 years, give or take, Florida Retirement Systems actuary is going to go through the same thing we do here, an experience study, and they'll make recommendations. It is from a national study of public sector pension plans that are comprised of police and fire. That is the table that we're adopting here. So I would consider it accurate, but we'll never know. You know, if I could get into a time machine and jump forward 100 years and look back at the mortality experience for this pension plan, then I could say today, oh, you know, it's correct or not, but we'll never know. I think largely it's a reasonable rate of, you know, people always ask me, what is the age? And there is no one age, but on average, I would say it's mid to high 80s for a member in their mid-career, police and fire here in Indian River. This table would say about mid to late 80s is the future life expectancy or age of death on average. I hear a lot, it's like, that's not, you know, not realistic, but, you know, it's a moot discussion to have. So anyway, I kind of belabored that point a bit. So that is the only assumption change built into this. I know there's another agenda item. We'll swing back to the other assumption items to discuss, but they're not built into this report. To the extent that the board adopts those other recommendations, they'll be built into next year's report. So remaining on this page, any questions or comments on the contribution rates? Going once, going twice. We can always swing back if needed. I mean, I'm going to say I've covered largely what I intend. I said I'm not an actuary to abuse the captive audience, but I will give you some interesting pull-out piece of information that are, I think, kind of interesting. If you go to page 17 of 149, just a brief history, the last 5 years of a couple of important assumptions, the reality versus the assumption. So on this page, if you look at the actual and assumed salary increases, this last year, the average salary increase for the participants in the plan was 6.02%. We assumed 8.27%. And you can just go down the line there. This was the first year in a while that the actual salary increase came in below the assumption. And then, of course, I don't need to tell you all what your investment performance has been, but there's a 5-year history. Fairly decent, but it's, you know, most of my plans use a smoothing. We've gone over that here before. You don't have any interest in the smoothing, which is fine. So you can see the assumption has been and remained, at least now for 5 years, 6.75% net of fees. So I think maybe where we can finish up before a couple of the other items for the actuary is just keep scrolling down, and funded ratio history, page 22 of 149. Just a snapshot, a rolling 10-year history. You know, another way of looking at funded ratio is how much money in the bank as a percentage of liabilities. And liabilities meaning how much do you need to invest today to pay for every future check that we expect to be cashed out? So just take that fraction, that ratio. The higher the number, the better. So you can see there's been some volatility here, which reflects really that you're not using any smoothing. The market goes way up, the funded ratio goes up. If the market goes down, the funded ratio goes down, largely. There's other moving parts. But you can see for the last 10 years, let's look at the extremes. The low in the last 10 years was about 85%. And there have been a number of years when you've been above 100%. Out of the last 10, just eyeballing this chart, it looks like 6 out of the last 10 you've been above 100%. So take that for what it means. Even on I will say this, you're so well funded at this point that the actuary's opinion of what do you need today to invest until every future check ever to be cashed, that includes for the youngest member in the plan to the oldest retiree. How does that compare to the money in the bank, market assets? And you're at about 100% right now, exactly. Meaning this over 100% is on an actuarial accrued liability basis, but on your present value future benefits for every check to be cashed, including future service accruals, future pay increase based on the assumption, you're right at the threshold of being 100% funded on that basis, which is very, very good. If that remains for any length of time, there's a little bit of a risk there regarding the Chapter 175, 185 premium tax monies. I'm not going to go down that rabbit hole today because the volatility here is such that I can't predict from one year to the next whether you're going to remain above 100 on the present value basis or not. But to the extent that if you would, for any length of time, say multiple consecutive valuations, remain above that to some significance, I want to put the board on notice that the state of Florida might take note and say, you've got to do something here, or your Chapter 175, 185 monies might be at risk. You're barely at the cusp right now, and any kind of an actuarial loss this upcoming year, you would fall just short of that 100%. So I don't have any particular concerns at this point. I want to put you on notice for it. And I probably confused everybody right now by
Well,
going
and
down
when
that
you
hole.
say the state might say that we need to do something about that, what does that look like?
Any number of things. The primary goal is to get that funded ratio below 100%. I don't have the full back of me, and I'm not going to put Lindsay on the spot. I don't have the full background as far as the rationale behind it, other than I'm thinking like an extreme example. Let's pretend that some pension fund it's been like 150% funded on present value basis for many, many years, but they keep getting premium tax monies from the local constituents by way of taxes on insurance premiums, hazard insurance and auto insurance. The state might say, look, you've got all this extra money you've been getting, do something with it, improve benefits. You can afford to improve benefits. You're 150% funded for many years. I think that's the concept. I can't imagine there's a trigger that when you're just barely on the cusp of 100% being invoked, but I have to make you all aware of it because it's kind of a rare thing and not everybody understands that. Most trustees aren't aware of it from year to year that there's this possible trigger. So I'll bring it up to the extent that I need to each year if you're around that 100%, just as a reminder. But right now there's no action, there's nothing needed. So again, I hope I didn't confuse.
Vice Mayor?
May I ask a question, please? For the record, Bob Alberter, Vice Mayor of the town of Indian River Shores. I think the actuary should be aware that back in 2018, we had a piece of surplus property along the ocean. And when we sold that, we had a fair amount of cash that resulted. And I and other members of council at that time saw that the pension fund was underfunded, both at the public safety level, and the OPEB was underfunded. We put the money in there. So I'm really sort of disturbed. Council did the right thing in terms of fully funding those pension funds. They were underfunded. Now you're saying that the state can penalize us for that?
Yeah, it's a valid point. I mean, I appreciate it. You know, I'm the messenger.
No, I understand.
Yeah, no, if,
I mean, this is
Yeah.
really important.
I
mean,
have to imagine that if we get to a point where if, you know, there's that 150% scenario, kind of an extreme scenario I came up with, I fully imagine that if the state decides, oh, it's time to write a letter, that this conversation will resume at that level. I have to imagine, but
Okay.
right now, right now it's informational. But point well made.
Councilman? Sure, please.
One surefire way of solving the problem is to reduce the assumed rate of return, which was increased by 50 basis points, I think it was 4 years ago, by the investment committee. What is the current assumed rate of return?
Probably 2018.
Yeah, I think it was that.
2018.
What's the current rate, assumed rate of return?
6.75 net.
675. I think that the committee at that time raised it from 6.25 to 675. So, and then that was very controversial, raising it. So if you want to get back in the good graces of the state, lower the assumed rate of return back to 6.25 from 675. That'd take care of it, I think.
That or improve benefits. Either one. Yes. Or both. I know, I'm stepping at it now, I know that. A COLA would go a long way to it, you know, post-retirement COLA.
Is reducing contributions, is that similar to increasing benefits?
No, because changing contributions, you just change who's paying, who's funding the plan. If you lower the members, then you increase the towns. That's just deciding who pays for the plan.
But that's not, that doesn't go into to what degree it's funded going forward?
That won't help your funded status by changing the contribution rate of the members.
So Doug, maybe you can repeat where we are on that timeline before we would be receiving a letter, or you have to report to the state? You have to be proactive in that, or is that, who initiates that?
I think the state, you know, call it the state, the Division of Retirement. There's a couple of reviewing actuaries who look through the valuation reports, but then there's a head of the police and fire wing of the Department of Management Services. I think the trigger might come from him. Right now, the seat is currently Steve Barden. You know, again, I'm not trying to put Lindsay on the spot. She's familiar with this topic as well, and perhaps she has some input.
You know, I've never seen it happen with any of our plans. We've come close. But I agree with everything Doug said. I think if you get to that point, and it has to be over a consistent couple of years, several years, the state will say something to you, right? The state writes a letter to you almost every year saying what they think the assumed rate of return should be. It doesn't mean you have to adopt it, right? But they say this is what we think it should be, and I think they would write a similar letter, and then it would be talked about. But you guys don't negotiate benefits, right? That's between the union and the city, and that would be a conversation if there are benefit improvements, or like the council member said, lowering the assumed rate of return, right? That's gonna change the funding. So I don't think you're at that point right now, so I don't think you should be concerned. If you'd like Bonnie to come at the next meeting with some additional background to see if she's had it, I can certainly tell her to and ask her to.
What is the state's recommended return now? We discussed this a couple of meetings ago. I think they've been coming down.
It's all of our plans, right? They usually say they want you to be between 5 and 6, right? All of our plans get that same standard letter.
Right, but in Brad left, but
you want to know what FRS is? Is that what you're asking?
Pardon?
What FRS is right now? I mean,
Sure.
They're 6.7.
They're 6.7. Okay.
So you're you're good, right? If the state ever says, we want you to do the same thing as FRS, you're in a good position, right? We have some boards that are in the 7.25s, right? But at this point, the state has not mandated that you have to have an assumed rate of return.
See what happens when you invite the actuary?
Troublemaker.
Yeah.
Right. Mr. Carroll, I think that the change in the act and the assumption was done back in 2018 or something.
Okay.
Yeah, like maybe in the midsummer. All I know is it happened at like my first meeting as a trustee. Yeah. Shanghaied. So it seems like this might be something to put on the agenda to discuss with Bonnie at the next meeting.
I'll let her know.
Maybe we can get Mr. Zweig at the Wall Street Journal to write an article about how we're overfunded. Because we've done such a good job. Right. In the meantime. Okay.
All right, do you need a motion for that, or are you going to continue to your next item?
Let's do this. If you don't have any other questions on the valuation report, I'm happy to answer, but if you don't, let's do two things simultaneously or back to back. We're going to approve this report, and then we need to go through the declaration of returns annual exercise. I'll do the first part, and then I'll help you with the second.
Okay.
So first motion is to approve.
Can I ask
the
one question?
evaluation.
One quick question, it's kind of down in the weeds, but I was
Absolutely.
reading a lot. There's a footnote, it's called low default risk obligation
Yes.
measure.
Yes.
And it says that you use a municipal bond high index.
Yes.
How do you, why would you use a tax-free instrument why wouldn't you use a U.S. Treasury obligation? Or a taxable?
For this purpose, this is an actuarial requirement. Kind of like, what's the liability assuming, no risk? We try to use a proxy for what no risk looks like on September 30th of each year, and we used the high quality bond rate, and we came up with 4.5% as a proxy.
Okay, I was just it's just.
Anything in that 4 range, 4.5,
Yeah, no,
I think would suffice.
It's unusual to see, a tax exempt index
Yeah.
integrated into a, non-tax.
Yeah,
non-tax investment.
there may not been that specifics, direction. So internally, we just said, what smells right for risk-free.
Okay, yeah.
And then we disclosed it.
Glad to hear that. I was just reading it. It was kind of interesting.
Sure.
Thank you.
Okay, so if we could start first with the motion to approve the valuation, if there's no further questions.
All right, do we have a motion to approve?
I'll make that motion.
Second?
All right, all in favor?
Aye.
Okay, now the declaration of returns. Any one of us could handle that, so I usually guide on this just because I've been the one talking. This is something the state of Florida has required for about the last 2 decades. There's no penalty for being wrong. You simply have to declare what you expect the return to be. There's very specific language. So I just usually give it, and then somebody says so moved. And it's for the next year, the next several years, and the long term thereafter, the board expects a 6.75% net of fees investment return. I plugged in the 6.75 because that's our recommendation, that you link it to your actuarial assumption. So now with all that verbose language, somebody can say so moved and then you vote.
So moved.
So can I get a first for approval of the declaration of returns at 6.75%?
Make that.
And a second?
Second.
Okay. All in favor? Aye.
Perfect, thank you.
So I guess next item for the actuary is, are you all prepared today? Just so you understand, this is swinging back to the experience study, the assumptions I recommended back at the October or July meeting that was pushed off a couple meetings. Because the decision wasn't made for this report, I just built in only the mortality piece because that's required. You don't have to make a decision today on the other assumptions, but I would like, and you can, but I would recommend that you do so before I do the 26 valuation a year from now and build it in. The mortality was the biggest piece. I understand that if you still want to stay at the 675, then the other pieces that we're recommending, there was retirement rates and salary increase, they were very modest. They barely moved the needle, but nevertheless, we still recommend that you adopt the other assumptions from that study, just so it can prove to the world, the auditors, the taxpayers, the state, and so on, that we are going through this exercise periodically about every 5 years. So that you can say, you can give an answer. When I give you the summary report and say, fund this contribution rate, if somebody asks you, on what basis are you using that, you could say, well, we do these assumption studies every 5 years or so. That's the purpose. But again, you don't have to make that decision today, especially if you're still kicking around the idea of the 675. Then that's a whole different story. So what's the board's pleasure? Did you want to resume this discussion again, or do we want to wait till a meeting or two from now and resume it in the context of the investment return assumption as well?
Well, I know we postponed it to this one. We had sent out because not everybody was here for the meeting prior. Did you all have a chance to come to a place where you felt like you were ready to make a decision on changing the other things that were proposed from the actuarial study?
Kyle, I guess my view would be if we know we're gonna discuss the assumption further at the next meeting and Bonnie will be here for that, right?
I believe so.
That we can move it, if we can move it down the road, maybe we should, because we'll have more information at that point.
I'm happy attending. I'll have Troy re-deliver the experience study to you and we can resume that discussion and go back over the results again. I think that's a good idea.
Right. Yeah, I mean, that's just my opinion. I don't know how everybody else feels about that.
To doing it, right? It's not cost to us.
His
other
just
than
me showing up and
right, yeah.
for the extra
But
meeting.
that's, I mean, other than that, there's not going to cost us anything to wait, right?
I mean, what's the downside of going ahead and approving it today? I mean, other than even if we revise the assumption later, there's no clawback or anything.
The downside, actuarially there isn't. It's more of the administrative, the flow of things, the efficiency of dealing with changes. Seems to me that you'd probably want to encapsulate that discussion on assumptions in conjunction with Bonnie's input on this funded status issue, all in one, like a standalone. And here we are a couple hours into this meeting. You've dealt with a lot today. So maybe it's, we freshen up, come back to the following meeting and say that's a better approach. That's just my thought.
Okay. Yeah.
I agree.
Yeah, sounds good.
All right, so we'll table the vote for the other items on the benefit study or the experience study, till we can discuss with Bonnie next meeting.
Yep, so Bonnie and I will both be here, and we can tag off each other on the whole big picture.
Yeah, actually, that's a good idea.
Great, thank you, sir. Do you have anything else for us?
I think the only other thing that you had for me is you were perhaps interested in, you get these annual member statements.
Right.
Annual meeting once a year, that greater frequency, and I wanted to have a discussion on that before I gave some thoughts.
Yes, go ahead.
So did I summarize that right, that there was a request for perhaps quarterly?
Yeah, it was Kyle.
So, yeah, a few of I believe it was in relation to the drop statements, were coming out at the end of the year and showing all 4 quarters in the one statement. So it looked like the work was being done throughout the year, but then just kind of held until the end. So we looked at, instead of holding it all, what would be the cost associated with getting out those quarterly numbers at the end of the quarter, rather than holding them to the end of the year.
And this is just for the drop?
Yes.
Oh, okay. Yeah, that's standard. Most of our plans, when it's based on plan returns, it is done quarterly. The billing, our billing for drop, I don't know the exact, I think it's around $100 per statement.
Yeah, that's what I was just looking at.
So if you wanted to do it quarterly, instead of $100, it'd be $400 per member, give or take. I have to look up the exact number, but it's right around 100.
So it'd be an extra $100 per member per quarter to get that done.
Yes.
$300 a year, right?
Additional, yes, per member.
How many members? No.
Well, it would only apply to the ones that are going into the drop. So I think we've only had 1 or 2 in the drop at one time. The one just retired, so technically we've got 1 now. And then I don't know that we have anybody that's actually going into the drop anytime soon. So what would we need to do if we wanted to implement something like that? Would that be some sort of a motion? Would something need to be drawn up? Would verbiage need to be changed in order to include that, and then we would vote on it?
Well, I'll let Lindsay kind of carry the weight on this one.
You can vote on it now, and we would draft an addendum to the contract to account for those extra benefit statements.
Okay. Yeah, so just to refresh you guys, when the members retire and go into the drop, their retirement check gets placed into the fund, and they get a statement. Now, those statements that I've seen, the member gets a statement at the end of the year, and it shows the yearly performance and it shows the quarterly breakdown. So what they were asking for is, rather than getting all 4 quarters at the end of the year, to get them at the end of each quarter to maintain, to see the progress and have a better idea of what's actually in that. Because there's no access, there's no portal, or you can't log into like your bank account to check the balance or anything. The only time you can see, is my understanding, is when that statement goes out. So instead of getting a yearly statement, they were requesting a quarterly statement, because the work had already been done. It wasn't like, it looked like the calculation had already been done during that quarter. It just wasn't sent out in a physical statement.
So just to give a little color. Oh, sorry.
I'm looking at your guys' agreement with Foster and Foster, and it already provide updates of quarterly drop balances, if any, for $104 per member per quarter. So it's already in here.
Okay. So to my knowledge, I don't believe that has come to fruition.
Okay, it's contracted for from the April, it was signed April 2024.
I think the connection here might be that the ordinance probably says annual updates,
Let me go check
I'm
that.
thinking, but if Lindsay agrees that the board can just make an administrative policy to increase the frequency, there's no cost, I mean, other than the extra 104. The language she just read is, you know, we build it in anticipation that it might be requested, meaning quarterly.
So what would be the total cost? Expense?
Well, it depends on, right now, I don't think anybody's in the drop, but.
Right.
We have one left.
One.
Okay, so annually, instead of 104, then it's
404,
404,
yeah.
so.
I guess what I'm saying is I don't have to amend the agreement because the agreement has been amended for it. So what I said earlier that we'd have to do that, we don't. It is already contracted for.
Seems like a pretty reasonable request. Sounds like a benefit. We can start horse trading benefits for actuarials.
You bless it, and Troy and I'll just take a note that starting now,
Yeah.
we'll start providing quarterly.
Yeah.
Well, as Lindsay's saying, though, it's supposedly,
Yeah, I'd say we.
you just have to execute it. It's already provided for.
It's in there, it just hasn't been approved for the financial part of it, the 104. So that's all you'll be doing.
Okay.
I think
Is that correct?
All right,
people
so
should know what the value of their
I
retirement
don't know the
assets is.
history of when you guys, what the conversations were around 2024. If you contract for something, that means you agreed to it, right?
It's been a conversation that I've had several times over the years, and like I said, I know that we've talked about it, but like I said, it just hasn't actually come to fruition since I've been on the board here.
It appears that everyone's in agreement. Is the motion required to be able to?
But she's
I
suggesting.
don't think it's required. I think you've already agreed to it.
I'm just gonna update it, Doug and I will
Yeah,
coordinate together, and we will make sure that it gets.
Reread
taken care
the,
Perfect.
of Per what the
Sounds good.
contract says.
don't have to do anything.
Great, thank you. Anything else, Doug?
No, unless you got something else for me, I think we covered everything with the actuary.
Great, thank you, sir. I appreciate it. All right, and from Klossner, Kaufman, Jensen, and Levinson, in for Bonnie, we have gone over the review of the article written about the fund and the 2026 IRS millage rate.
Is there anything else you guys want to talk about with regards to the article? No?
No, thanks.
Okay. I'll go over the IRS mileage rate. Starting for January 1st, 2026, any business where you're traveling on behalf of the board, you now get 72.5 cents on the dollar. So that's 2.5 cents more than you got last year. So we'll let you know. Sometimes that changes throughout the year. We'll let you know if it does. And I have a second memo for you all. It's not in your packet. It just got sent out.
Actually, I did get it in
Oh,
there.
it got in there. I'm
Yeah, so
sorry.
next page, 136.
136 of your iPad. So this is just more informational, not necessarily for you all, really for your plan sponsor and for Foster and Foster. There's several different documents and reports that needs to be publicly displayed on the plan sponsor's website. And if the plan has a website, then there is some contact information. I'm sorry. There is some contact information that you also need to include. So this is really just an FYI. We're recommending that Troy sends this to the clerk just to let her know if these are the things that should be displayed on the plan sponsor's website. Any questions on that?
Got to get to the page first.
So you're saying this would be posted on the town's
Yes.
website?
The only thing that you need to, if you have a website, it's helpful to have these documents on there, but the only thing that you would need to post is the public records custodian, which is Troy. But this is really for your plan sponsor. I just think with over the years, when people move in and out, not everyone knows the information that must be posted, so it's really just our office just trying to be helpful. Any questions on that?
So would this be on the town's website?
Correct.
Okay,
Plan sponsor, correct.
okay.
Plan sponsor.
And who coordinates with them to make sure that this information gets posted?
So Troy,
That's us.
Okay,
So that will be handled, not specifically by me, but part of our team.
okay.
Okay.
And do you need a motion here to approve this? No?
you might already be doing this, and I think that's what she's going to speak to right now.
All this information is located, if you go to the town's website, it's under the finance department's website.
Okay.
Thank you.
Thank you.
That's all I had for you all.
Great, thank you. All right, Troy, Foster and Foster, educational opportunities and the annual conference.
Okay, so just the PBTA conference is coming up June 28th through July 1st in Orlando. If you're interested, this is the big one, so this is one that fills up the fastest, has the most people attend. This is where the vendors have displays inside the big auditorium. You can go up, talk to them, ask questions. We're there, attorneys are there, consultants are there, other vendors are there. So if you haven't been to that, I'd recommend going to one of those. And if you want to go to that, send me an email. I'll put you in touch with our analyst. The analyst is then going to send you a survey form so that we can help get you registered and track as you do things. And so once you do that, they're going to then sign you up. They're going to send you a confirmation that you've been signed up, and they'll send you your hotel registration information. And that's also a way to track all of your expenses. So if you're interested, do it ahead of time. I'd recommend letting me know at least 60 days ahead of time because, like I said, once it opens, it gets filled fairly quickly. We want to make sure you get registered and get a hotel room in where the meeting is at. So just send me an email within 60 days of the meeting. That's my recommendation. And that's it for that, and we can kind of move straight down to the consent agenda if that's okay. And the consent agenda starts with a summary. That's on page 137. Do I need to? Yeah, I was just going to say. If there's any questions about the summary or any of the warrants that are all included in the overall consent agenda or the fund activity report, I'd be happy to answer. Otherwise, if there's none, I'll be looking for a motion to approve the consent agenda as a whole.
Move to approve the consent agenda as presented.
Okay, and a second?
Second.
Okay.
All right, all in favor? Aye.
Aye.
Okay, thank you. And so that's it. We're down to trustee reports, discussion, and action.
All right, anything further to discuss?
No.
All right, our next meeting is scheduled for Tuesday, April 28th, 2026 at 2 p.m. At this time, 4:15, meeting adjourned.
All right. Thank you.
Thank you.
Thank you.